Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to the first Through the Noise podcast for 2026. I hope you're all able to take a little bit of time off in December to prepare for what promises to be an exciting year ahead. But the two things that jumped out to me as I opened my Bloomberg in the first working day of the year was, number one, the rally we experienced by many precious metals, particularly late in December. And second, of course, what I'd call the return of geopolitics with the events around in Venezuela in the early days of the year. So, how should investors think about navigating this exciting start to the year against the context of what we put out in our 2026 outlook? To discuss this and more, I'm very happy to be joined today by Fook Hien, who's a senior investment strategist in the CIO office. Welcome, Fook Hien. Thanks for joining us for the first podcast of the year. I think just picking off where we started, looks like we've already had a lot of theater from the start of the year with the US moves on Venezuela, obviously the conversations around Greenland. How have markets performed and what's your outlook early in the year?
Yeah, hi. Thanks, Manpreet. So, risk assets have rallied this year already, despite U.S. actions in Venezuela and the threats on Greenland. Now, non-U.S. equities, especially our preferred Asia ex-Japan equity market and precious metals have outperformed, which is extending 2025's trend. So this underlines the need for diversification and hedging. We remain pro-risk for this year, given the solid outlook for corporate earnings, the easy fiscal policies worldwide, and a Fed that is increasingly aligned towards cutting rates, with the looming change of guard, should be positive for equities. Meanwhile, precious metals, they have a tailwind in a world fraught with geopolitical risk, while the US dollar faces risk, especially against the Japanese yen. The alternative investments, they provide a route to better risk-adjusted returns amid the heightened uncertainty. The equity bull market is now entering its fourth year. We see strong corporate earnings outlook globally on the back of resilient economic data, supportive fiscal policies, and the Fed rate cuts. All these provide a solid fundamental backdrop to risk assets. However, as the events at the start of the year have shown, diversification and hedging, they remain key in the new year. And this underscores our positive stance on Asia ex-Japan equities, besides US equities. We also like emerging market bonds and gold minor equities, as well as alternative assets. The Venezuela intervention is medium-term positive for US equities in our view, and negative for oil. Now, if the US secures control over Venezuelan oil assets, as President Trump claims, it is likely to be positive for US equities over the medium to longer term, because Venezuela has the world's largest proven oil reserves, and actually more than 5 times that of the US itself. So monetizing Venezuelan oil will take years, given the country's decaying oil infrastructure. So any near-term gains would be limited. The revival of Venezuela's oil industry, it may open opportunities for the mega US oil producers and service providers. Also, US gasoline prices have fallen over the past month, which should help keep inflation expectations in check, paving the path for further Fed rate cuts. Meanwhile, the latest moves on Greenland, they are bullish for Europe's industrial sector, especially the defense industry. There are near-term risks to watch out for, though. This include the US jobs and inflation data, a Supreme Court decision on Trump's tariffs and whether they are illegal, and also any US intervention in the unrest in Iran. It would pose a short-term upside risk to oil prices, and it would further raise geopolitical risk.
Thanks, Fook Hien. Quite a bit to unpack and take in there, but let's focus a little bit more near term. The upcoming US earnings season, what are your expectations there, including from a sectoral perspective?
Yeah, we expect the US earnings growth to be modest in the Q4 of 2025, but then it would reaccelerate thereafter. Sector-wise, we prefer in the US the technology, healthcare, and utilities. So the major US banks will kick off the US earnings season, and the consensus expectation is for Q4 2025 earnings in the US to grow by 8.9% year on year. And this is a deceleration from 14.9% seen in Q3 2025. Thereafter, we expect growth to reaccelerate to a range of 14 to 18% over the next 4 quarters of 2026. And these are based on a source from LSEG IBIS. Now, corporate guidance on the 2026 outlook will be critical in driving further gains in US equities. We expect US earnings to grow by 15.6% in 2026, following 13.3% growth in 2025. The growth in 2026 is likely to be led by the technology sector at over 30% growth amid the strong AI investments, and also the materials sector at over 20% growth just amid a cyclical recovery there. Sector-wise, we favor a barbell approach in our sector strategy with growth exposure from technology along with defensive exposure from healthcare and utilities. We expect AI applications to drive growth in technology, particularly in semiconductors and software. And then in healthcare, we expect innovative medicine to drive a 9.2% earnings growth in 2026, while valuation there remains reasonable. And this year as well, we expect a 9.4% earnings growth in utilities, which is boosted by electricity demand from the data center build-out.
All right, and maybe moving over to China, where we've got quite a surge in AI IPO since late 2025. So, what's your view on China's technology sector?
Yeah, we see rising investments giving a tailwind to China's technology and communication services sectors. The leading domestic companies with a substantial AI chip exposure are likely to benefit from this. So the recent wave of AI-related IPOs or initial public offerings in China, it highlights a robust market demand for technology stocks. The capital raise is set to accelerate R&D across the emerging sectors with a pronounced impact on companies specializing in advanced semiconductors, data centers, and robotics. So these segments are poised to benefit from the ongoing technological breakthroughs such as AI integration into industrial automation and the expansion of high-performance computing infrastructure. If you look at China's 15th five-year plan, emphasizing technological self-reliance, all these aligns with the developments we are seeing. So we expect supportive policy measures and a strong technology and communication services sectors in China to drive a continued re-rating in valuations. China technology sector is likely to deliver earnings per share growth at 33.6% in 2026, and this is far surpassing MSCI China's expected 11.2% EPS growth. At the same time, valuations remain reasonable with a 12-month forward PE at 23.6 times, which is around its 10-year average. So we continue to be overweight on China's growth sectors, especially technology and communication services, and we will also highlight our opportunistic idea on the Hang Seng Technology Index.
Thanks, Fook Hien. I guess we can't end a podcast without talking about precious metals. So, very quickly, do you expect gold and silver to extend gains after what we experienced in December?
Yeah, now we see silver is likely to face a short-term headwind from stretched investor positioning, although medium-term momentum remains strong. We remain bullish on gold, and we would maintain an opportunistic preference for gold mining equities. The prices of precious metals have accelerated sharply, and while silver will continue to benefit from manufacturing demand, particularly linked to AI and electronics, its recent outperformance can arguably be attributed to a catch-up trade with gold. The gold to silver ratio has fallen sharply from its recent peak to its lowest level since 2013. This sharp move lower suggests that further gains in silver prices from here are likely to be increasingly dependent on momentum and technical factors rather than supply-demand fundamentals, which appears to be quite well priced in. So our preferred catch-up trade here actually is looking at the gold mining equities, which have performed strongly since we initiated our bullish idea in October 2025.
All right. Thanks very much, Fook Hien. I think that just about brings us to the end of time. So thank you very much for taking the time to speak with us today. Very quickly, top 3 takeaways from today's conversation. Number 1, the importance of diversification and hedging. Number 2, a barbell approach may be appropriate in US equity sectors, preferring technology against more defensive exposure to healthcare and utilities. And finally, in precious metals, silver still arguably has room to rise after a potential pullback, but gold miners, of course, are our preferred gold catch-up trade. So if you'd like more, please do take a look at our annual outlook for 2026, which we published earlier in December, if you haven't done so already. But thank you very much, as always, for dialing in today, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.